This shouldn't be happening. Right now, the paper silver market tried to push prices down, but the mining stocks just stopped listening. The algorithm that's controlled silver for the last decade just broke. In the next 5 minutes, I'm going to show you the internal market data that proves why the big banks have lost control of the miners. If you think this is just a normal green day, you're missing the biggest structural shift we've seen. Something broke today. Not crashed, not corrected, broke. And if you're holding silver or mining stocks, you need to understand what just happened in the last 6 hours of trading, because this changes everything we thought we knew about how these markets actually work. Here's what you missed. While most investors were watching the usual suspects, at 11:47 a.m. Eastern Time this morning, the Global X Silver Miners ETF, ticker symbol SILJ, recorded a volume spike that we haven't seen in over a decade. We're not talking about a nice bump or even a strong rally day. According to Bloomberg terminal data, today's volume deviation measured 8 standard deviations above the historical norm. For those of you who remember your statistics class, 8 sigma events aren't supposed to happen in financial markets. They're the kind of anomalies that should appear once every few billion years if markets actually followed normal distribution patterns. But here's where it gets really interesting, and this is what should make every single person watching this video sit up and pay attention. While SILJ was going absolutely vertical with this unprecedented volume, spot silver, the actual metal price that's supposed to drive these mining stocks, was trapped in a tight 50-cent range, barely moving at all. Think about that for a second. The junior silver mining stocks are exploding with volume we've never seen before, and the underlying commodity they mine is just sitting there like nothing's happening. That's not how markets are supposed to work, and it's definitely not how they've worked for the past 10 years. What you're witnessing is what we call a paper to physical fracture, and it's the kind of market dislocation that only happens right before something massive changes in the pricing structure of an entire asset class. Let me explain what's really going on here, because understanding this mechanism is the difference between seeing this as just another volatile trading day and recognizing it for what it actually is, the beginning of a complete repricing event. For years now, the silver market has operated on 2 separate tracks that most people don't even realize exist. There's the physical market, where actual bars of silver change hands, get delivered to vaults, get turned into solar panels, and AI server components. Then there's the paper market, which is exponentially larger, where futures contracts and derivative products trade, based on silver that doesn't actually exist in any vault anywhere. These 2 markets have coexisted in an uneasy balance, with the paper market generally setting the price that physical buyers and sellers have to accept. The algorithm I'm referring to in the title isn't some conspiracy theory or hidden software. It's the very real, very documented process by which large banks and market makers use program trading to keep the paper price of silver within certain boundaries. The Bank for International Settlements has published research showing that precious metals markets rely heavily on algorithmic trading strategies that respond to specific price triggers and volume thresholds. These algorithms are designed to sell paper contracts whenever physical buying pressure starts to move the spot price too quickly, effectively capping rallies before they can gather momentum. But here's what changed today, and this is critical for you to understand: the mining stocks. The actual equities in the companies that dig this metal out of the ground just broke free from that algorithmic control. For the first time in a decade, we're seeing a silent decoupling where the miners are moving independently of the spot price manipulation. The equity market is telling us something that the commodity market is being prevented from showing. It's like watching a pressure gauge spike while someone's desperately trying to hold down the release valve. You might be wondering why this matters to you personally, whether you own mining stocks or not. Let me paint you a scenario that connects this directly to your financial life. If you're saving for retirement, if you've got money in index funds, if you're planning major purchases in the next few months, you're about to experience the downstream effects of what happens when a critical industrial metal, and silver is absolutely critical to the technologies we depend on, goes through a repricing event, while global supply chains are already stretched thin. Now let's talk about what's happening today specifically, because today isn't just another day on the calendar. According to options data from the Chicago Mercantile Exchange, there's a massive wall of call options sitting right at the $29 to $30 strike price that expires at the close of trading today. We're talking about open interest that represents tens of millions of ounces of silver in notional value. Market makers, the big institutions that sold these call options to speculators and hedgers, are now in a position where they desperately need to keep silver below these strike prices to avoid a cascade of obligations they may not be able to fulfill. Think about the mechanics of what has to happen if silver closes above $30 today. Every single call option that finishes in the money creates a delivery obligation. The market makers who sold these options are contractually required to either deliver actual silver contracts or pay the cash equivalent. But here's the problem that's created this 8 sigma volume spike in the mining stocks. There isn't enough physical silver available at current prices to satisfy these obligations if they all come due at once. So what are the smart institutional players doing? They're not fighting for scraps in the manipulated spot market. They're going directly to the source. They're buying equity in the mining companies themselves, which is exactly what this volume explosion in SILJ is showing us. When you can't get the physical metal because the paper market has created obligations that exceed available supply by orders of magnitude, you buy ownership in the companies that control future production. It's the only logical move, and we're watching it happen in real time. This isn't speculation or theory. The data is right there in the volume numbers, in the options positioning, in the divergence between equity prices and spot prices. What we're seeing today is the market's way of rooting around a control mechanism that's no longer able to contain the underlying supply-demand reality. The algorithm that's kept silver prices suppressed through unlimited paper contract issuance is running into a hard wall. You can create infinite paper claims, but you can't create physical silver out of thin air. Here's what you need to understand as we head into the close of trading today. This isn't about whether silver goes up or down by a few percentage points. This is about watching a fundamental breakdown in how price discovery works in a market where paper derivatives have been used to override physical scarcity. The volume we're seeing in these mining stocks is institutional capital making a calculated bet that the emperor has no clothes, that the paper market's ability to set prices is about to end very abruptly. By the time the closing bell rings today, we'll know whether the market makers successfully defended that $29 to $30 call wall. But regardless of what happens in the next few hours, the fact that junior mining stocks experienced an 8 sigma volume event while spot prices barely moved is telling us something that hasn't happened in modern commodity market history. The algorithm broke today. And when systems break, they don't slowly repair themselves. They either get abandoned or replaced entirely, usually in ways that catch most players completely off guard. Before we go deeper into what this means for the next days and weeks, you need to understand the basic supply dynamics that set up the conditions for this break. Because this isn't about a single day's trading action. This is about years of structural pressures finally hitting the breaking point. Silver isn't just a precious metal or an investment asset. It's the most critical industrial metal that nobody talks about. While gold gets headlines and crypto dominates social media, silver is quietly becoming the bottleneck resource for every major tech transformation we're going through. The average smartphone has about 0.5 grams of silver. That might sound trivial until you multiply it by the 3 billion devices made every year. Each electric vehicle needs between 25 to 50 grams of silver for everything from battery connections to power electronic systems. Solar panels, which are now being installed at record rates as countries chase carbon targets, use about 20 grams of silver per panel. And here's where it gets really interesting from a supply standpoint. The AI revolution that everyone's talking about, the data centers running these models, the network infrastructure supporting them, they're completely dependent on silver. A single AI server has more silver than 10 regular computers combined because of the thermal management needs and the density of connections. Microsoft, Amazon, Google, they're all building massive new data centers. Each center needs tons of silver just for the electrical infrastructure. Now here's the problem that sets up the conditions for what we saw today. Annual global silver production is about 1 billion ounces. Industrial demand alone, not counting investment demand, is now running at about 900 million ounces per year and accelerating. We're talking about a market that's already eating 90% of supply with demand curves that are going vertical based on the growth rates we're seeing in EVs, solar installations, and AI infrastructure. There's basically no buffer left. And this brings us to the geopolitical element that nobody's talking about, but that I think is the real trigger for what's happening today. China controls about 65% of global silver refining capacity. They're not just mining it, they're processing the concentrate from mines around the world and turning it into the refined forms that manufacturers need. Recently, just last month, Chinese officials put in place new export licensing requirements for refined silver. The official reason was environmental standards and quality control. The practical effect is that Western industrial buyers can no longer count on the smooth supply that they've taken for granted for decades. Tesla can't just order silver on the spot market and expect delivery in weeks like they could 18 months ago. Now they need licenses, they need approved suppliers, they need relationships with Chinese middlemen. This isn't happening in a vacuum. This is China using their control over critical material processing to gain strategic leverage in the exact industries, EVs, renewables, AI, where Western countries thought they could keep technological leadership. When you control the refined supply of the metal that's essential to these technologies, you control more than just a commodity flow. You control the pace of industrial change itself. And this creates an impossible situation for Western manufacturers. They can't stockpile months of inventory because silver is expensive to finance and store. They can't easily switch to other materials because silver's unique properties, highest electrical conductivity of any element, highest thermal conductivity of any metal, make it irreplaceable in most high-tech uses. So what happens when you have demand accelerating, supply constrained by geopolitics, and a paper market that's been acting as if neither of these realities exist? You get exactly what we saw today. The real economy players, the companies that actually need this metal to make products, start bypassing the paper exchanges entirely and looking for other ways to lock down supply. And one of those ways is buying equity ownership in the mining companies themselves. If you can't reliably buy the metal, you buy the company that produces it. That's not speculation, that's just basic supply chain risk management. And it explains why we're seeing such crazy volume in junior mining positions on a day when the spot price barely budged. The smart money knows that the paper price is living in fantasy land while the actual supply situation is getting increasingly dire. Let me show you something that should make this even more real. Last week, Tesla, not some small speculator, but Tesla, the car company, announced they'd signed direct purchase agreements with 3 different mining companies. They're basically pre-buying future production at fixed prices. Microsoft did something similar a couple months ago with other mining companies. These aren't commodity traders or hedge funds making these moves. These are industrial companies that have realized that relying on spot markets for critical input materials is no longer safe given what's happening geopolitically and with supply. And here's what that means for today's market action. When big industrial players start doing off-market supply deals, they're basically saying that the paper market price is wrong and unreliable. They're willing to pay premiums to actual mining companies because that's better than risking production shutdowns. That's the signal that the equity market is picking up that the paper market is ignoring. The stock prices of mining companies are starting to reflect what these companies' output will actually be worth when supply constraints force prices higher. Not the paper price that pretends everything's fine. The real clearing price where industrial buyers are willing to transact to secure supply. And that brings us to the mining company economics that make this even more interesting from an investment perspective, whether you care about mining stocks or you're just trying to figure out where prices are headed. The typical junior silver mining company operating today has all-in production costs between $18 to $25 per ounce, depending on ore quality and location. At current spot prices around $29, they're making modest margins. Nothing spectacular, but workable. But remember those off-market deals Tesla and Microsoft are doing. According to Bloomberg reporting, those contracts are being structured at prices between $40 to $45 per ounce for delivery starting in the third quarter. $40 to $45. That's 40% to 50% above current spot prices. And these are real contracts being signed right now by companies that need to lock down supply. If that becomes the new effective price for mining companies' output, you're talking about changing the economics of the entire sector overnight. A mining company with $20 costs selling at $40 instead of $29 doesn't just make 10% more profit. They more than double their margins. And stock prices don't move linearly with metal prices. They move exponentially because small percentage changes in metal price create huge percentage changes in profit margins when costs are fixed. This is what the volume explosion in junior mining positions today is really about. This is institutional money realizing that if off-market deals are already happening at 40 plus, the paper market price sitting at $29 is living on borrowed time. And when that price reset happens, it's not going to be gradual. It's going to be violent because there's a decade's worth of paper positions, of bank exposures, of hedging strategies, all built on prices that no longer reflect supply constraint reality. Now let's talk about the paper positioning that makes this situation even more explosive. And this gets technical, but it's important for understanding why we might see something really extraordinary in the coming days and weeks.